Welcome, everyone. I'm Mimi Taylor Hendricks, the president of the board of SHED, Sustainable Housing and Equitable Development. SHED has been in existence since 2009, focusing on assisting seniors, disabled residents, and veterans with minor exterior home repairs, with a priority being given to those residents who have been cited by the city or have issues staying in a home that keeps them safe, warm, and dry. This home ownership education series is an idea that SHED has had since its inception with the new board in 2019, but it was been delayed primarily because of COVID. So why are we focusing on home ownership? Well, for us at SHED, we focus the majority of our work on the third ward. We are working on creating some kind of parity among the wards. We know that home ownership stabilizes a neighborhood. We know that since the housing downturn of 2008, the number of rentals in the third ward has doubled, and that's alarmingly more than has happened in the other two wards. And in my words, as a neighborhood on the edge, we know that the third ward can either improve or deteriorate based on the attention or neglect that it receives. We also know that home ownership is one of the largest assets most people own, and it has a history of appreciating in value. It's also one of the most common ways that parents can pass on wealth to their children, this concept of generational wealth, along with life insurance. So with the help and knowledge of several of our board members, local University City realtor Cindy Theory, and several banking experts, SHED has created a series of presentations focused on the preparation and process of purchasing a home, the various channels of assistance that exist to help with costs, and the issues of maintenance that will need to be considered when buying a home. I want to make it known that from this moment forward, this seminar will be recorded. And if you have any questions as we go through this, please feel free to put them in the chat box. To kick off the series, our first presenter is going to be Juan Villarreal. He is a CRA loan officer with PNC Bank in the Chicago, Illinois area. He's been there for 7 years and has been in credit and financing for 10 years before that. Even though Juan is located in the Chicago area, he has helped facilitate lending all across the country. He loves being able to help people realize their dream of home ownership and understand the challenges that they face.
Folks, I want anybody that's on the call to use the meeting chat. If you have any questions, feel free to type them into the chat. I don't want any question to go unanswered today, and I'll either answer them during the presentation or at the end, depending on where it fits in, if I can fit it into part of what we're already talking about, okay? There's no right question, there's no wrong questions, there's no dumb questions. Like, every question is fair game. We're all at different places in our lives, and I want to make that clear. What I want everybody on this call to take away is have a takeaway, have an aha moment during the call that you can say, oh, now I know. Oh, that's easy. Take something with you. I'm going to share a lot of information. I don't expect you to memorize it all. That's okay. Take 1 or 2 takeaways that you can take home with you to think about as you move forward on your journey. Okay. So you can see my screen, realizing the American dream, achieving homeownership. This is always the dream for many, many years, right? And it still is. The American dream. By the way, I didn't choose that house. It was one of my peers that put that house there. I would have chosen a cooler house, but anyways, realizing the American dream, that is what this is all about. And it really is having your what you call your own place, your own home. So I tell everybody this: purchasing a home, it's a simple process. Not always an easy process, okay? But it is a simple process, and if there's a few key steps that you can get out of the way, that upward hill becomes a downward hill very quickly. And I'm going to show you how today. But here's the steps to obtain a mortgage. Before you do anything, before you meet with a realtor, ideally, some folks will meet with realtors ahead of time, and that's okay to get an idea. Realtors really want to focus on someone that's already pre-approved. So meet with your loan officer. Have a heart-to-heart conversation with your loan officer, whether that's somebody with PNC, Chase, your local bank, it doesn't matter. Get a recommendation. Find someone that has your best interest at heart. Meet with them. Tell them what you want to accomplish. Give them a timeline. They should be asking you all these questions. Okay? They're going to go through everything. What type of house you want to buy? What's your budget? How much is the monthly payment? The whole gamut they're going to go through with you. If everything looks good, they're going to give you what's called a pre-approval. Now, a lot of banks are doing what's called digital pre-approvals now. Digital pre-approvals, basically it's a pre-approval, but it's digitally. It comes through your email. You get it right in your email. You can print it off. You can forward it to your realtor right on the spot. Once we do that, once you get your pre-approval, you can shop. You can start shopping with your realtor. The pre-approval is going to tell you exactly what you qualify for. Your realtor will get that letter, and they're going to see, okay, you qualify for X amount, and they're going to show you homes that are within that range, what you qualify for. At some point, you're going to find a house that you love, and you're going to say, hey, let's make an offer on that house. You're going to make an offer. In a perfect world, they're going to accept that offer, and they're going to write up a contract. You would all send your loan officer the contract. They would send that to finish up the application, and they would send it to underwriting for a decision. Number 5, they're going to give you a loan commitment and a final approval. Number 6, your loan closing. Number 7, you are a homeowner. Like I said, it's pretty simple. There's a lot of little things in between here, but I'm going to break those down for you. Okay? But that's, in a perfect world, that's really what you should be looking for. Meet with your loan officer, get pre-approved. Now, I want to be clear. Not everyone's going to get pre-approved in that first shot. If you're not able to get it pre-approved that first time, do not get discouraged. You're not alone. There's a lot of folks that just don't get pre-approved. But where there's a will, as I mentioned earlier, there's a way. Where there's tenacity, there's a way. Okay? So let's dive into a little bit deeper. Pre-approval, a formal loan commitment that's issued by the underwriter, the underwriting team at the bank. So to receive that pre-approval, again, meet with your loan officer. They're going to ask you questions. They're going to ask you where are you looking, what type of house, how much do you want to put down. They're going to determine that monthly loan amount you qualify for. But I want to say, just because a loan officer qualifies you for a X amount of dollars and X payments, I always tell everybody, you're qualified for a $1,500 payment. Can you see yourself making that payment every month? If it's an overwhelming yes, awesome. But if you tell me no, you know what, I'm not comfortable with $1,500, I can do $1,200. Then we are going to back down a little bit and we're going to find something that's in that $1,200 range. So when you talk to a loan officer, don't just go with the first thing they say. Understand what that payment's going to be. Understand what that payment consists of, and make sure you feel comfortable with it. Okay? On top of that, the mortgage loan officer is going to let you know how much money you need for down payment and closing costs. In a perfect world, you should always have some money set aside for down payments and closing costs. If you're not saving, get yourself on a savings plan. Just a good mental habit, physical habit to do every month. Now, there are ways to help out with down payment and with closing costs, and we'll talk about that. But I always tell customers, bring some skin to the game. Have some funds available, because if they're not going to go towards your down payment and we can help you with closing costs, well, then you can use them as an emergency fund, or you can use them for furniture or appliances or whatever it is that you need for the new home. Okay. Now, I did mention there are ways to be creative with the down payment and the costs, which is the next line here. I'll give you an example. PNC offers a grant. That grant is anywhere from $3,000 to $5,000 that can go toward down payments or costs of the loan. Now, we're not the only bank that offers a grant. I want to be very candid. There are multitude of banks out there that do offer the grants, but we do offer it, and we have a very nice product when it comes to that. But again, we're not the only one. I just want to be clear. You can also get not only the grant, you can get seller concessions. So a seller can say, hey, I'm selling you the house for X amount of dollars. I'll give you 3% of the price of the house back towards your costs. Now, seller concessions are a wonderful thing. They're not always possible. If it's a really hot property, they're less likely to give up a concession or give a credit back to the seller. But a lot of times we'll see them where you can get, and I'll give you an example. If you're buying a house that's $200,000 and the seller says, okay, I'm going to give you a 3% seller credit. Well, that's $6,000 that they'll give you to push back towards your cost, which is huge. So there's creative ways, folks, to get that down payment paid for and that the cost paid for. Okay, so don't be afraid. Don't think that, oh, I need all this money. Yeah, you need some money. You need some money to bring to the table, but it's not as much as usually most people think. That misconception, you 20% is not valid anymore. There's ways to do it. You will never know though unless you have a conversation with your loan officer. Okay. Now the MLO will work with you to determine what that monthly payment is. They'll run your credits, and they'll do a pre-approval. Now there's pre-approvals where you're approved based on your credit and a couple other factors. There's also pre-qualification where it's just a conversation. This is what I can potentially get you approved for. I'm not going to run your credit today unless you want me to. That's a pre-qualification. Pre-approval, we've gone through, we've pulled credits, we've gone through the numbers. You're good, right? So just know the differences between pre-qualification and pre-approval. All right, so how do we determine your payments? We're going to get an interest rate. In general, there's two types of interest rates. There's your fixed rates, which are the most popular, and there's adjustable rate mortgages. Now, your fixed rate mortgages are going to be your conventional loans, your FHA, your VA, veterans loans, jumbo loans, first-time home buyer loans. All of our loan programs offer fixed rates. Adjustable rates are not always the best thing. There's a place for them, but not for most people. Adjustable rates are more for maybe somebody's going to buy a house gets moved to work. They get sent out to California. They're working on a 2-year contract or let's say a 4-year contract, and they're coming back to Illinois or St. Louis or wherever they're at. They might do a fixed rate or adjustable rates to save a little bit on the rates in a short amount of time. But those adjustable rates will eventually adjust at some point. The fixed rate will stay fixed for the entirety of that loan term, whether that's 10, 15, 20, or 30 years. All right, let's dive deeper into the loan officer conversation. I'm going to harp on this a little bit because I think this is going to be the most critical conversation that you're going to have in your journey, okay? Ask all the questions you can during that conversation with your loan officer. That first conversation should not take 10 minutes or 15 minutes. It should be a good half hour to an hour. Really get in deep into what you're looking for. Because we got to think about what's the loan type? What's the loan program we're going to use? There's a variety of different programs out there that we can use. Then we got to figure out what the loan amount is. And we got to figure out the term. Is it 10-year, 15-year, 20-year, or 30-year? Very upfront, the most common term is 30 years. Doesn't mean it's the right term for everybody, right? We got to figure out what's the right one for the customer in front of us. The interest rates, very important. It's going to your monthly payments, and also your PITI payments. I'm going to pause. PITI payment stands for your principal, your interest, your taxes, and your insurance. Remember, folks, you're not only paying the money to your bank, which is the principal and the interest, you also have taxes, property taxes to think about. Property taxes are what you pay to your county. And you have your insurance. You're going to want to pay to your insurance company, whether that's State Farm, Geico, whatever other companies are out there. A good tip, if you're ever looking for insurance, I would start with whoever insures your auto loan, your car, because they usually can bundle up a deal if you do the home with them. Usually. Doesn't mean that's the way to go. But yes, you think about that. You have your principal and interest to the bank, you have your taxes and your insurance. All those things are going to go into your payments. So keep that in mind. If you have the luxury of living in Illinois like I do, you have the highest taxes in the country. So that's not always ideal, but I think you all folks are going to be in a little better position when it comes to taxes, I think. But yeah, don't just things to think about when it's out there. So moral of the story is lay it all out there. Make sure that we're seeing the full picture so you understand what we're doing here. And then how much money do you need to bring for closing costs? So you have your down payment. Your down payment for a first-time home buyer or for anybody is going to be anywhere from 3% upwards to 5% and above. Usually 3%, 3.5% for an FHA loan. What's the loan amount? So if you have a $100,000 property, you need $3,500 down payment. You also need some money for costs. Okay, so these are things that we're going to evaluate to see. Okay, where are you at right now, and where can we help? Right? Where can we fill that gap? Where can we meet? Everybody's different. I've never had the identical conversation with two folks, right? But that's kind of what you're going to discuss. Hey, this is what I have. And maybe what you have is not enough. That's okay. Because if it's not, then we're going to figure out a plan to get you to a place where you have enough and you can succeed. Maybe that's a month from now. Maybe that's 6 months from now, a year from now. It doesn't matter. It's okay. You're on your path, right? And we're going to get you there. If you have, I'm going to take your term, Amy, tenacity. Keep moving forward. Okay? So, diving deeper into your conversation with your loan officer, you're going to discuss your personal financial details with your MLO. And they're going to ask you for some documents. Typical documents you may see, depending on what you do for a living, they're going to ask you for bank statements. We want to see where that money's at that you're using for your down payment and the cost. We want to see probably some pay stubs if you work for a company, some W-2s for the past couple of years. There's probably going to be an application that you'll sign digitally. You give your loan officer permission to run your credit. We want to look at credit. And there also, when you do find a house, there'll be an appraisal that's going to be ordered. The purpose of the appraisal is to make sure that the home you're buying is really valued at what you're buying it at. So if you're buying a $140,000 home, the appraiser is going to go out there and confirm that that home is $140,000. Okay. So I got a little ahead of myself. These are some of the documents you may require. So we may require 20 and 21, and this is very 10,000 foot view. It doesn't mean this is what everybody requires. Or again, everybody's different. W-2s. Sometimes we'll need federal tax returns if somebody's a business owner, or if somebody works on commission or has more than 25% of their income on commission. We'll need some pay stubs. We need the bank statements. We'll need the sales contract. If you get to that point, we get the sales contract, and that's the goal, right? The sales contract and all the addendums to make sure that we can look through it, make sure that everything looks good, find out what our closing date is, who the title company is, who the realtors are. We get all that information from the sales contract. Some other stuff you may need, depending on credit, the underwriter may ask you to explain some things, write a quick letter. Divorce can happen. If there's a divorce, recent divorce, we may need a divorce decree. If there's a gift, you actually can get a gift from a family member or a close friend for down payment. That's a fantastic option. If you have somebody that's willing to give you a gift, we just need a gift letter that the donor signs. We do need explanations of large deposits. So let me talk about large deposits. And I run into this quite a bit. A lot of folks are getting into the habit of saving money, which is fantastic. A lot of folks have the habit of taking the money and sticking it at home, putting it underneath the bed, or putting it in the safe at home, or wherever they put in the coffee can, right? And they save up their money and they're saving, and it's a fantastic habit to save. I've told everybody, save your money. Then they go and they find a house, and like, I got the down payment. It's in the coffee can at home. They take the cash. They've been saving for 2 years, and they go take it to the bank and they deposit it into their bank account. Somebody have a question? So they go deposit it into the bank, and then the bank statement shows that this person made a cash deposit. Well, unfortunately, we cannot accept cash deposit as an asset toward the home. Why? It's the short answer. It's not traceable. There's a lot of rules and regulations behind it. So if you're saving up, ideally you want your money to be, and again, I'm not against keeping money at home. I think it's fantastic. But if you're saving up for the specifics of buying a home, have it in a bank, show that it's been deposited, and you're going to make your life a lot easier when it comes to your bank verifying that income or those assets. That makes sense. All right. Let's take a step sideways a little and talk about what's called debt to income ratio. So how does a bank figure out how much you can afford? Very simply, we use a math equation. It is called debt to income ratio. And in the simplest term, we take your monthly income. So let's say in this case, it's $3,000 gross. It's the gross monthly income. Let's say somebody makes $36,000 a year. And we multiply it by 40. It's actually 45%. The person that created this was a little bit conservative here. We can go up to 45%. Let's say we're using 45% in this case. So that number gives us $1,200. So again, think about how much you make every month, gross. Take your yearly salary divided by 12, but give your monthly gross. Multiply that by 45%. That'll give you a number. What that number means that all your total monthly payments and debts cannot, in this particular case, for this particular person, cannot exceed $1,200. So what do we look at specifically? So we look at the house they're buying, the principal, the interest, the taxes, and the insurance. We look at those 4 components. But we also look at what's on their credit report. We look at any car payments they have, any student loans they have. We look at credit cards. We look at the minimum credit card payments that they're making, that the credit bureau is showing. And we need to make sure that all that fits into the $1,200 for this particular customer. The more you make, the higher that this number gets. Okay? So it's an equation. We want to make sure that the purpose of this is to make sure that we're not putting somebody in a situation that they can't afford. Okay. Now we don't use every debt. We don't lump everything into here. Like cell phone, car insurance, utilities. We're not counting that. It's just the stuff that's on the credit report: the car payment, the student loans, the minimum credit card payments, and the new home that you're purchasing. That's how we figure it out. And again, this is our number. This is a number that we come up with that I say, Mr. and Mrs. Customer, this is the $1,200. This is what we think you can afford. Just because I think the bank thinks you can afford it doesn't mean you feel you can afford it. That's when you have to go back and say, nope, that number is too much for me. I want to be about $200 less, and have that conversation. Okay. The debt to income ratio, very simple, just a quick equation. We figure out what we think somebody can conservatively afford. Okay. So let's say you've checked all the boxes. You checked all the boxes, you get pre-approved, and you're gonna get a loan estimate with all your costs on there. And the loan estimate that we give you, or that any lender will give you, is gonna show you what's going to be due at closing. So that estimate used to be called a good faith estimate, and I just call it a loan estimate. And you'll see kind of a snapshot of what you'll need to bring to closing. You'll see your costs and your fees associated. You'll see your prepaids. You'll see how much cash to close you need to bring to facilitate the transaction. So that's your loan estimate. When you first talk to a loan officer and you have a house in mind and you apply, you're going to see a loan estimate. So when you see it, it looks like a complicated piece of paper. It's not that complicated. It just shows you a breakdown of the fees that are associated with that property in that transaction. Okay. So what are some of the potential roadblocks? Before I go here, I'm gonna simplify this for everybody on the call. When I talk to somebody for the first time, first thing I always do is I'm having a conversation with them. I don't touch my computer. I might take some notes here and there, but we're having a heart-to-heart conversation. I want to find out exactly what that person is looking to do, who they're looking to do it for, what's their why, what's their timeline, right? And once we get to that part, once we cover all that, there's three things that I tell every customer that we look at as a bank. Remember, I said the process is simple. It's not always easy, but there's three things that are going to happen. We're going to talk about credit. Okay. Credit has to be above a 620, ideally, right? The higher, the better. Once we talk about credit, we're going to look at what the current debts are. We're going to talk about their income, make sure they have enough money to make that payment every month, and then we're going to talk about their assets. The assets is how much money they have for the cost and a down payment. If we get those three things in line, well, 90% of people will get to the finish line if we get those three things in line. Every now and then, there's some other roadblocks that come into play here that could be impact us. So I'll talk about number one, high debt to income ratio. What does that mean? Remember we talked about that 40% on this page? Well, sometimes I may come across a customer and they're at 70%. What do you all think that means? Is that good or bad? Anybody can type it in the chat box. 70% debt to income ratio. Is that good or bad? Well, that means that that person is going to be using 70% of their income, which was not allowable. So we need to bad. Thank you, Mimi. So it's not good. We get them down about below 45%, right? We want to make sure that when we loan somebody money, if they have enough money to pay the rest of their bills, family, all that good stuff, right? So that's one. Job instability is number two. We need 2 years of total work history, and ideally, we want to see stability at the current job. Now, there's always, if there is instability, I need to know what the story is. I gave birth. I got laid off because of the pandemic. What is that story? So we try to get as close to stability as possible, right? We're going to look back at least 2 years. That's what we want, 2 years of job history. Credit rating and score below the guidelines. 620 is the lowest score we take. There's a couple of programs that go below that. I won't go too deep into that right now, but like VA can technically go below that. But 620 for most programs. Some programs are 640. The higher the credit score, the better, right? So if somebody is credit challenged, then we try to put them on a path to correcting that, right? With any of these things you see, insufficient funds to close. What does that mean? Well, we don't have enough funds to close this transaction. Case in point, I had a couple 2 weeks ago that is looking to purchase a home. They were looking to purchase a home in Ohio. They simply did not have enough funds to buy the home that they wanted to buy. And they were dead set on this home. So I had a heart-to-heart with them. And the home they were looking to buy did not qualify for any grants or anything. But I told them, like, this is not, you are not ready for this home at this point. We need more funds. So two things. We need to either find a home that's lower price that maybe fits the funds you have available, or let's get in a plan for the next 3 or 4 months, put money aside and let's get the funds that we need to purchase that home. And that's what they're doing right now. I hope they stay patient, they stay on the path, because we'll get them there at some point. Low appraised value property issues. When you purchase a home, we're going to make sure we're doing due diligence. As you all as buyers, you're going to send out an inspector out to visit the home. They're going to look at everything, make sure the home is in good condition. When we go out, we're going to send our appraiser out there to make sure the home is valued and make sure there's no general issues with the home. We want to make sure that our customers are being put into good quality, ready to live in, move in homes. Not all homes are ready to move in. Some homes will have issues. We'll find out through the process. That's not always a fun scenario, but it is what it is. So to give you an example, I just had a home where they had a deck in the back. They had a pool in the backyard. The seller removed the pool. There was a deck that was left over, but the deck did not have railings. So if somebody walked onto the deck, they can fall because there's nowhere to brace themselves. So before we close on our loan, we asked the seller, like, you need to put up railings to make this safe. So our appraiser went back out there yesterday, revisited it, saw it. They put up the 2x4s, looked good, clear, good to go, right? Question, so an appraisal is different than an inspection. Yeah, so the inspection is an inspector that goes out there and looks for specific issues with the home. Okay, that they're going to look at the roof, the gutters, the plumbing, the basement, make sure there's no leaks, cracks in the foundation, things like that. Our appraiser is going out there more to verify the value, but they're also going to look at stuff that the lender needs specifically. Like, they'll look at the roof, they'll look at this one specifically, the pool that was removed. You know, they're looking for things that are safety hazards that potentially could impact the buyers of the home. So they are different. They're two different companies for sure. We send out the appraiser. I never talk to the appraiser, but usually you'll work with your realtor to get an inspector that knows the area and things like that. Cindy said, in the next session, we'll discuss the home buying process step by step. Be sure to register for future sessions. Yes, folks, so make sure you register. This is what I'm showing you today is just the tip of the iceberg. There's so much to learn. And again, education is key. Education is key to get you to the place where you want to get to if you're looking to get to home ownership. I'm not going to touch too much on here. These are the key loan terminology. Loan to value, basically it's a term that the lender uses. It's another equation. They take the loan amount divided by the sales price, gives us, in this case, a 97% loan to value. Down payments, the money that you put up ahead of time down on the house to purchase the home. And depending on the program, could require a down payment of 3%, 5%, whatever the program is. Loan estimate, we talked a little bit about loan estimates, going to show what all the costs are, any fees on a loan. CD, a CD is not what you play in a little CD player. It's actually a closing disclosure. You will get your CD before closing. It's going to have all your final numbers on there, how much cash you need to bring to close. Interest rate, self-explanatory, the cost of annual cost of borrowing money. Annual percentage rate, or APR, is a little bit different than the interest rate. The annual percentage rate is what the loan actually costs you. So we'll take the interest rate plus the total cost of the loan, and they'll merge that, and it's going to tell you exactly what the total cost of interest and closing costs are over the life of the loan. So whenever you get a quote from a lender, you'll get your interest rate and you'll get your APR, annual percentage rate. Those are going to be different, and it's just the annual percentage rate is just a reflection of what the overall cost of the loan is. Points, I'm not going to go too deep in here, but you can always buy down your rates by paying points. Mortgage insurance, that's something that we'll talk about briefly here. Mortgage insurance, anytime you're putting down less than 20% on a home, you'll end up paying what's called mortgage insurance. It's a little bit of money added to the monthly payments to cover that gap of not having a 20% down. By the way, I've been doing this 7 years at PNC. I would say 95% of my purchases have mortgage insurance. Okay. Escrow accounts, when you hear that term, it's going to be money set aside to pay taxes and insurance. Your lender will pay your taxes and insurance for you. What they do is they set up an escrow account so that that money, when it's due to your county or to your insurance company, it comes right out of there, it gets paid to them directly. And then any loan fees are just fees in a loan. Could come from the lender, could come from the title company, the appraiser, the county. So those are your fees. Fees vary by loan product and by financial institution, so check with your MLO. All right, this is the final page. We want to make your homeownership dreams come true. I don't have my name in there, but I'm going to type my name in the box here. And I want to open it up, if appropriate, Mimi, for any questions.
Yeah, I definitely, because I'm not seeing much in the chat, but if you've had anything has crossed your mind as you've been listening to this, if you want to unmute yourself and go ahead and ask your question.
Don't be shy, folks. If you don't have any questions, that's okay. That's okay. But again, like I said, there's no dumb questions, nothing like that. Every question is valid. But I guarantee if you're thinking it, somebody else is thinking it. Well, I've posted my information in the box, the meeting chat, my name, my direct email, and I put my cell phone number in there. If you all have any questions that I can answer.
Yeah.
Oh, we got a question. How does one qualify for the grant?
Okay.
That's a good question, Ada. Thank you. So PNC has a grant that's either $3,000 or $5,000, and it's going to be based off one of two things. Number one is it has to be in a qualifying county. We have qualifying counties across the U.S. So number one, it's got to be in a county that's like most counties. We have most of the counties in our system. There's a few that aren't, but it has to be in a qualifying county. That's number one. Number two, the property has, if the property, once we verify that it's in a qualifying county, if we find out that if you're buying a county, if you're buying a home in Chicago here, Cook County, I know Cook County is qualifying, right? So if you're buying 123 Grant Street in Cook County, Illinois, Chicago, if that property falls in a low to moderate, or sorry, let's say low or moderate census tract, you would qualify for $5,000. So if you're in Cook County, Chicago, and the home you're looking at is low or moderate census tract, you would qualify for up to $5,000. Now, if that home is in Cook County, but the census tract is not low or moderate, if it's middle or upper, we can still qualify for $3,000, is if your income is 80% or below the median income level. Okay, so it's either by, you have to be in a county, and then after that, it's got either the property's going to qualify or the borrower's income is going to qualify, the higher of the two. That's pretty much it. But yeah, we do a lot. I was just putting Missouri also has some grant programs I'll speak into on my slide. Perfect.
Okay, good.
And then that's just, yeah, to Cindy's point, that's just our grant. There's a bunch of other stuff out there. Down payment assistance programs galore. You just have to find the right programs. Every area is different. Most down payment assistance programs are going to be state and county specific. So yeah, definitely talk to your realtors, loan officers to see what's out there. What can you potentially qualify for? And do your own research too. Absolutely. You never know. You never know. They're like, look, I'll give you Chicago, for example. Chicago there's so many programs out there. I don't know them all. I know a lot of them, but there's at least 80 of them out there that I know are out there currently. How is the overall housing market right now? That's an interesting question. I think it's picking up. I think what happened over the past few months is, okay, so give you guys a little bit of history. If you look back at historically where rates have been, if you look back at post-COVID, rates were down into the 3%. They were historically the lowest they've ever been. So a couple of things happened. Because rates were so low, people were like, I need to buy a house. Rates are super low. I can't miss out on this. I'm gonna buy a house. And a lot of folks just bought houses because the rates were that low, right? It made sense. But now rates have gone up. So they've gone up to where they used to be. They're like 6%, call it 6.25%. Sometimes they fall into the 5s. It's balanced out. When you see on TV or on your newspaper that the rate you have is 3, now they're 5, what does that do? It creates fear in a lot of people. Like, I don't want to sell my home where I have this low interest rate to go buy something, even though they're probably going to make money off their home because the values have gone up significantly. But then I got to go buy something at 6%. So that's caused a lot of fear. And just generally speaking, number one. Number two is some folks don't want to sell the house that they're in. I have this house. I want to buy another house. I'm going to keep this house. I'm going to rent it out. I have a 3.5%. I'm just going to rent it. So what has that done? Generally speaking, it's caused there's less inventory in the market. There's less inventory in the market, meaning there's less selection of homes right now. For most areas, not all areas. Some areas are still booming. I have areas of Chicago where you can find homes, and there's other areas. Berwyn is one of the areas I work in. Historically, there's always like 40, 50 homes for sale. The other day I checked it, there was 9 homes for sale. But I can't tell you this, it's cyclical. It ebbs and it flows. So don't be afraid of the market. Don't be afraid of what you read and what you see. Talk to your loan officer. Am I saying it's the right time to buy right now? No. It comes down to your situation. It comes down to your need. Case in point. I actually had my cousin call me up the other day. My cousin and his wife called me up. And they live in a small condo in Chicago. Their neighbor is selling a home. Significantly bigger than the home they're in. They want to start a family. They want a bigger home. And their interest rate right now is 3%. And I told them your new interest rate is going to be about 6%. It's double on a higher priced property. And they're like, well, I don't know. They're asking me, what do you think? And I told them, do you know what I think? And I looked them straight in the eye and said, is this the home for you? Like, what do you mean? And I said, is this the must-have home for you? If it is, then that's a risk you might want to take. And then when rates come down a year or two from now, you can refinance the home. But if your answer is going to be from me, no, if they were just for sale and we thought about it and we thought we might, well, no, then in that case, probably not the home for you. Maybe you could wait that out. So it depends on your scenario when it comes to purchasing a home in this market. At least that's my opinion.
Well, if we have time, I know there's a couple of other questions that are in the chat, but I think Cindy might be able to answer those in her presentation.
Yeah, absolutely.
Okay. All right. So I want to thank you for being on with us tonight. Thank you for all the information and the basic introduction to some of the points we need to consider when we're thinking about buying a home, and the costs and the processes associated with that. So I want to thank you for being with us tonight.
Yeah, thank you for having me.
Okay, thank you, Juan. Cindy, I'll turn it over to you. You have some slides, and maybe you can also address a couple of the other questions that are in the chat.
Sorry, I didn't know I went over so far. Sorry about that.
That's okay. Go ahead.
Sure. Okay. Let me get to that real quick. Okay. It was cutting off the slide, so I'm just going to share like this, if that's okay, so everyone can see. So what did I want to talk about real quickly is we've talked a lot about the loan process, and I want to back up a little bit and talk about, we were just talking about, is now a good time to buy? Well, one thing you might think about is if you're renting, or, you know, some people are living at home and saving money. And that's kind of an interesting statistic, because currently the average rate of the first-time home buyer is 36 years of age. So if you think that you're behind the gun, you are not. Many people are renting. They're finding that challenging, so they may move home to save money. But what are the benefits of purchasing over renting? Well, when you buy, you are paying yourself, essentially. You're gaining equity and you're building that personal wealth. And I'm going to go through these slides real quickly. Oh, it's going to scroll here. Okay, so here's an example for a $300,000 house. So consider yourself, if you were renting and you're paying $2,500 a month on rent over 360 months, which is, you know, the average life of a loan, you are going to pay, you're going to, lose out $900,000 in lost equity from your rent, right? So look at this next column. If you buy, you know, your average down payment is going to be $15,000. You're going to borrow $285,000. You're still going to have that $2,500 a month payment, but over that same span of time, you're going to end up with that $900,000 in outlay, but you will have earned $285,000 in equity, right? So that's, equity is what you own in your home. So how does that help you? Well, you can sell your home and buy a bigger home, or you can borrow against that equity and take out a home equity loan. If you want to start a business, there are different ways that you can use that equity in your home. So that is one reason why it is good to purchase over renting, if that is possible for you. So let's talk about, for those that are first-time home buyers, and what is the definition of a first-time home buyer? Most people think that it's someone who has never owned a home, and that is true. That is a first-time home buyer, but it also refers to someone who hasn't owned a home in the past 2 years. So if you owned a home, say you moved out of state and decided to rent for a while, if you haven't owned a home, in the past 2 years, you are still considered a first-time home buyer when it comes to most lending institutions. And then there are other definitions, and one is if you previously owned a home with a spouse or another person. If you get a divorce and are going out and buying a home on your own, you are considered a first-time home buyer because you're doing that on your own. So again, when you're talking to your lender, you know, go through all of these points with them, because they may have programs that can help you. So I'm not going to go over this. You'll get this chart in the handouts that we email out to you, and we are going to talk about this in the next session. But these are the 10 steps to buying a home. And since we're kind of short on time, I'm not going to go through them very quickly, but you heard Juan talk about, saving for your down payment, know your credit score, right? And a lot of people go out to Credit Karma or one of those, and they think that's their credit score, but that's not your real mortgage credit score. A lot of people are surprised when they fill out that application. They're like, why is my credit score different? So there is, what I call a mortgage credit score, and it's very different than, like I said, the Credit Karma. Then you're going to want to find a real estate agent, and I'll go into that in just a bit. But then once you get pre-approved, you find a home. And then I always say that's kind of the easy part. The hard part is getting to close, but we will talk about that in a future session. So we talked real briefly about grants. Someone asked that question about grants. So here in Missouri, there are some programs, but I'm just going to go through these bullet points because this is all types of home buying programs. So a lot of what we talked about today was more along the lines of conventional, but also there are different ways to buy a loan. And I'll just give you a quick scenario, because Juan also talked about that debt to income ratio. Well, I just had a young couple, they're unmarried, relocating here to St. Louis, wanted to buy a house. They filled out their loan application, and the boyfriend had not secured a job yet, but the girlfriend had a job. So it was actually better for the lender to remove the boyfriend from the loan application and go with an FHA loan. And so what is an FHA loan? That's that first bullet there. And why did he do that? We won't, these are questions that you can ask your lender, but there are easier credit qualifications. There's more advantages when you're dealing with some negative credit. They can let you, if you have a lot of credit card debt, they can let you pay it off. And then they have a low down payment plan. So with an FHA, and Juan, you can always jump in and correct me if I am saying something incorrectly on the loan side, but with an FHA, you can put as little as 3.5% down. But that will mean that, you will have to, you'll ultimately have a larger monthly payment, but in this particular situation, they went from 5% to 3.5%, and it was a $30 difference in their monthly payment. So VA, there are VA loans. And so if you're a veteran, you can get loans. They require no down payment. They have competitive low interest rates. There are lots of benefits. I only listed a few here, but there are many benefits for veterans and VA loans. There are also city and county down payment programs. The Missouri Housing Development Commission has a couple of great grant programs. One is the First Place Loan, and one is called Next Step. They both have income requirements, first-time homebuyer requirements. We'll send that flyer out from the Missouri Housing Development Commission program with the materials that we send out. But essentially, one of the programs, you can get up to $6,000 toward your closing costs, down payment and closing costs. And the other program, depending upon the location, you can get reduced interest rates. So I had someone who was buying a home in Lafayette Square. Because of the location, they were able to get a 6.325 interest rate when the interest rate was more like 6.25. So those are some other ways, to help you get into that house. And then, as Juan mentioned, there are lender programs. And so talk with your lender about what they have available to you. And I should also mention here that and I think Juan mentioned this as well, there are lenders who have credit repair programs. So I know of a lender, they have a savings program to help you build your credit. And this is for those that have no credit as well. So they open up this savings account for you. You put money into that to build credit. And then at the end of that, you also have money towards your down payment. So those are just some of the programs that are available to you. I'll talk real quickly, just as I'm a real estate agent. If you go out, and realtors are like every other profession in the world, there are great ones and not so great ones. And so just when you go out there in the world, make sure that you are asking questions of your realtor. You know, what areas do they specialize? How do they, plan to communicate with you? How do they determine what your needs are? Lenders and realtors have really great relationships. And so if you find a lender that you trust, you might even ask them for a referral for a real estate agent, and vice versa. So I hope I shared a little bit of information that was helpful. I know that's really quick, but we are tight on time. So Mimi, I am going to stop sharing and turn it back over to you.
Okay. Thank you, Cindy. I appreciate that. And I'm going to go just into the chat because there were a couple. And let me know if it's something that we can answer briefly here. I'd rather not just automatically move something to another session of the series. If we can just give a brief answer, if you know it's going to probably be addressed more in detail later. So one of the questions was, when you're talking about buying and building, getting a home and all of that, how does it work if you want to buy land, a lot, and build? Is it this basically the same process?
Juan, do you want to take that one?
Yeah, generally speaking, it really depends on the scenario, but if you're looking to buy a lot, you would need a lender that is going to provide financing for a lot.
Okay.
Generally speaking, PNC is currently working on the construction of permanent loan. That's another type of loan that's available. But yeah, generally speaking, you want a lender that's going to be able to finance that lot. A lot of lenders won't, some do. So you just do a little bit of due diligence and research to find a lender that's going to do that for you. And then you could go from there. Yeah, it's pretty straightforward. Just,
Okay.
There's not as many offerings.
Okay. Does getting pre-approved affect your credit score? Is there a way to check your mortgage? And you mentioned something, Cindy, which I had not heard before, that there's a difference between what we may assume is our credit score. For instance, the FICO score that may show up on my MasterCard bill every month. And it tells me what my FICO score is. But you alluded that there's a difference between that score and my mortgage score. Okay, so that's one question. But the other one was, if I get pre-approved, because I've heard this too, don't run my credit because that affects my credit score somehow, some way. So can you get pre-approved, and how does that affect your credit score? Anybody? Juan or Cindy?
Can it impact your credit? Potentially. Rarely. If you go run your credit with a lender, it's not going to have a big impact. Generally speaking, every scenario is a little bit different. We typically, what we do is go ahead, Cindy.
I was going to say, here in Missouri, I've heard couple lenders tell my clients just recently that you can pull it up. You can have 3 lenders pull before it affects your credit. I don't know if that's a universal or if that's just a local thing.
Yeah, I think you have like a 2-week gap to do that. To be able to shop around and see what's out there.
Okay.
That's pretty accurate.
But what you might include kind of in that question is, once you are pre-approved, don't do anything to change your credit, right? Don't go buy a washer and dryer on your Home Depot card, or don't go buy a new car, or go change jobs. You want everything until you close on that house to remain the same, because that will affect your ability to purchase that home.
Wow.
Yeah, great point.
Okay, there was one other unusual question. Can I buy a house in my children's names alone? So not me as the owner and my children, I may be through will or something as beneficiaries or whatever, or co-owners. Can you buy a house in your children's name alone?
Well, I would probably need more details. If you have typically if you have older children that can credit qualify and kind of go through the qualification process, the short answer is yes. But yeah, it depends on the scenario. But if most of the time, if we're talking about like smaller children, not really. You have to, the person on the loan needs to qualify. Like again, going back to the credit, to the job stability, or to the income, and then to the down payment funds.
Because they're the owners. That's the name
Yeah.
that's going to be on the mortgage. Okay, got it.
Correct.
Okay.
But there are scenarios where a parent, if they are able to buy a second home in their name, they could quit claim it to the children.
Okay.
Mhm.
Okay. All right. What's the typical time frame to get a closing from a completed application? So you get a completed application. What's the I don't know, average amount of time till we actually get complete, get the closing and get the keys to the house?
Probably about 30 days.
Yeah, that's
Something
the
less,
average.
something more.
But it also depends on how diligent you are about responding to your lender with the documentation they need, right, Juan?
100%. I get
Okay.
some of my customers are very honest. They're in it. They're in it to win. They get their stuff quickly, and there's other people that let their other things get in the way. So if you have that focus in mind, so you want to get into the house, and where there's a will, there's a way. That'll
Okay.
definitely, you have that mentality, that'll speed up the closing.
And
Okay.
related to that, I would say if you get pre-approved, especially in this market, so talking about this market, St. Louis, and Juan said this, right? St. Louis inventory is super tight right now. So one of the things you can do to make your offer stand out among other offers, because especially in the price point, well, gosh, almost anything under 500,000 all the way down, because there's so few properties on the market, they're getting multiple offers. And so there are ways that you can write that offer to make yours stand out. And one of those is being able to close quickly. And so, especially, if it's a vacant property, the faster you can close, the happier that seller will be. And so once you get pre-approved, keep going down that process toward approval so that once you're through underwriting and totally approved, you can close in 2 weeks.
Okay. Another question says, can a bank statement showing salary payments, I guess direct deposits of your salary, be used in place of the 30 pay stubs?
We generally need pay stubs.
Okay.
There's things we look at on the pay stubs, deductions, things like that, to make sure everything matches up. So in most cases, we need pay stubs. There's some companies that when we run our automatic underwriting, the pay gets confirmed through the system, and we don't need pay stubs, but not every company is like that. So usually I would say, to answer the question, no, we can't use bank statements, but sometimes there's other alternatives to verify the income.
Okay. All right. Any other questions? And if not, one of the things I want you to put in the chat, if you think about it, are there other topics that you would like to see covered in future educational series? Are there specific topics you would like to see covered? And we'll see if they're already going to be covered in the future sessions, or if we need to add something else in. So if you can think of a topic that you would like to have either more discussion on, or there's something you've not heard that you would like to have a question about. Okay, what did she say? What if you change jobs and don't have access to the old pay stubs? Are there ways still to get into that?
Well,
The bank
we're only
has?
looking for 30. We're looking for the last 30 days.
30
If you change
days?
jobs, yeah, we're looking for 30 days worth of
Okay,
stuff. So we
yeah.
just recently changed jobs. We just wait for the 30 days.
Okay, okay, all right. So again, put in the chat if there's any topics that you want to make sure that are covered in the future. Okay, Cindy has added in the chat the link to the flyer that shows the other 3 sessions that are coming up this year. You will have access to the replay of this series and this particular session and all the sessions on the SHED website. And since you registered through Eventbrite, we can send that recording directly to you. Is that correct, Cindy? That they'll be able to, we'll send it to
Yes,
you.
we'll give them a link
a
to the SHED
notice.
website, yes.
Right, yeah. And then you can go ahead and at your leisure, you can watch it again or listen to some of the sections again.
Or share with your friends.
Yeah, but and by all means do that. You know, this was our first session. This was the first time we've tried to do this. So please make sure that, you know, if you know of others who have been talking about trying to buy a home, that you tell them about this so that they can get involved and watch and learn and listen in the future sessions. They can then have also a link to this first one as well. But just pass the word on, because we do want to increase. As folks working with SHED in particular, we want to do a couple of things. We want to see more parity among the wards, particularly in terms of the percentage of home ownership versus rentals. Because we believe that homeowners are more invested in their neighborhood and bring more value to the neighborhood, more stability to the neighborhood, more care for the neighborhood. So that's what we're looking to do. All right, so don't forget to register for the future sessions. I'd like to thank Cindy Theory from Norm McCarthy Realty for being involved in helping us set up this entire session, and Juan Villarreal from PNC Bank in Chicago for being with us this evening. And if there are no other questions or concerns, I want to thank you for being with us, and I hope you have a wonderful evening.
Thank you, everyone. Have a great night.
Good
Thank
night.
you. Okay.